Hello everyone, and a very warm welcome to this ICAS webinar on the periodic review amendments to UK GAAP. For those who don't know me, my name is James Barber, Director of Policy Leadership here at ICAS, and I have the pleasure of being your host today. It is vital that businesses and other organisations applying UK GAAP plan ahead so that they are in a position to comply with either the revised FRS 102 or FRS 105. 3.4 million organisations are believed to be impacted, so there's a lot of work for accountants and auditors to do, getting up to speed on the detail. Organisations will be impacted to a greater or lesser extent, depending on their particular circumstances. However, understanding how your organisation will be impacted is the first key step in planning for the changes, including gathering the information on lease arrangements and contracts with customers. So over the course of this webinar, we will take a look at some of the key areas of change, including the following. New disclosure requirements for small entities, applying Section 1A of FRS 102. The five-step model for accounting for revenue from customers with contracts under FRS 102 and FRS 105. The single lease accounting model for lessees under FRS 102. Exemptions from lease accounting under FRS 102 and the transitional arrangements. To explain and help us understand some of these matters, I'm absolutely delighted that I'm joined by Jenny Carter and Stephen Maloney from the Financial Reporting Council. Jenny is the FRC's Director of Accounting and Reporting Policy and leads the development and implementation of the FRC's strategy for standards and related guidance in respect of corporate reporting. This includes UK and Ireland accounting standards, as well as guidance on the strategic report and other corporate reporting guidance. Jenny is a chartered accountant with over 30 years' experience. Her previous roles include being a senior manager at PwC, head of technical accounting at the BBC, and director of UK accounting standards at the FRC. Stephen is a senior project director in the FRC's accounting and reporting policy team, leading the team's projects to develop and maintain the financial reporting standards applicable in the UK and Ireland. The Periodic Review 2024 has been his most significant project since joining the FRC in 2021. Previously, Stephen spent nearly 15 years at Deloitte in audit and accounting advisory roles. Now, before we begin, just a few housekeeping matters to remind you of. Firstly, you can submit questions at any time through the Q&A facility, which can be accessed at the top of your screen. Questions can be submitted anonymously. We will be saving all your questions until the end of the webinar for a live Q&A session. Please also join the conversation today through the chat box accessed at the top of your screen. This allows you to comment or discuss with fellow attendees on matters covered by this webinar. The FRC is keen to hear your views on topic areas where additional guidance would be welcome. So please include any thoughts you have on this in the chat box throughout the webinar. We are, of course, recording this webinar and will make it available for on-demand viewing afterwards in case you want to refer back to it or share it with others. The recording will be shared with those registered for today's event in a follow-up email, and we will also upload the recording to our events page on icas.com after the in-person FRC event has taken place on the 18th of September. And I do hope to see a lot of you at that event as well. We look forward to receiving your questions throughout the course of the webinar, and of course we will try and get to as many of those as possible. I know there's a huge amount to get through, so I'll now pass straight across to Jenny to get into the detail of today's webinar. Jenny, please.
Thank you, James, and hello, everybody. Right, I think we'll probably quickly move on as we've from this slide, as we've already introduced ourselves. So, right, what we've got here is a bit of an overview. So, as James has already mentioned, UK and Ireland accounting standards, financial reporting standards, are applied by an estimated 3.4 million entities. So that is quite a large number of entities. And we're very pleased to be here today to help inform people about those changes. We do periodic reviews approximately every 5 years. This is the second one. We started it in 2021. And the idea of spacing out those periodic reviews is that we have a period of general stability in between periodic reviews where there aren't hopefully very many changes to accounting standards. It's often difficult to avoid some changes as there may be urgent topical issues that need to be addressed, although often those don't affect all entities. But we like to do these periodic reviews approximately every 5 years. It gives a chance for the most recent changes to have bedded in a little bit, which allows entities to provide feedback on how they're working in practice before we then think about what changes, if any, we need to make going forward. So this particular periodic review, as I say, we started it in 2021 and we published the amendments, the 2024 amendments, in March of this year, with most of them effective from the 1st of January 2026. So that does give people some time to get ready. And of course, that's the start of the relevant accounting period. And in most cases, that will be a 12-month period. So it would be into 2027 before the reporting itself appears. This time, there are some comprehensive improvements to FRS, and we went through a process of quite significant stakeholder engagement, starting off by getting some initial feedback around what things entities might want us to look at in the periodic review, as well as, of course, the formal consultation as part of an exposure draft. And indeed, this time, because we're looking at revenue and leasing, we actually had done some earlier engagement on how to approach updating FRS 102 for those standards going back some years earlier, I think in 2016. So this has been a fairly long process of engaging with stakeholders about the amendments we're talking about today. And the amendments we're making, as always, are designed to enhance the quality of financial reporting in the UK and Ireland, and that should help support growth and access to capital with improved information about an entity's financial performance and financial position. So just to further sort of delve into the overview, what are the most significant changes? I think these have already been trailed to some extent. Revenue recognition and lease accounting are being aligned with, we've said here, recent changes to IFRS accounting standards. Of course, those standards, IFRS 15 and IFRS 16, have in fact been in effect for IFRS reporters for some years now, and that is part of it's deliberate in that we look at how have these standards, or we consider how have they been implemented by IFRS reporters. Does that provide us with some useful information about how perhaps we might simplify things for users of FRS 102 and 105? And as I said before, the intention is that this will provide better information to users of financial statements, including current and potential investors and lenders. Now, revenue and leasing aren't the only things to change. For those of you who've picked up or looked online at the amendments document, it's almost 300 pages long. So I think we would hope that it wasn't only revenue and leasing. Although, of course, one should remember that amongst that, with the way we present amendments, is that we will set out a whole paragraph and then mark up the changes. So that doesn't mean 300 pages of new text. So that is worth remembering. But there are a number of other things in there as well as revenue and leasing, all of which are designed to improve reporting. And some of the smaller amendments are particularly designed to make it easier to apply the requirements that were already there. And Stephen will be talking a bit more about a few of those later on. And again, it's all intended to lead to high quality and comparable financial reporting. Now, one thing some people might be interested in is a few things that have not changed. Obviously, we generally focus on what has changed, but some things haven't changed, and some particular areas that will be of interest. So one thing we have not made any changes to is the impairment model for financial assets. So we have not introduced an expected credit loss model. We have, however, said that we will revisit this. The IASB has been thinking about this as well in the context of the IFRS for SMEs accounting standard. We'll be interested to see where they end up with that project, and so we will be revisiting that, but for the time being, no changes to the impairment model for financial assets. We have not made any changes to align with IFRS 17, and should we propose that, there will be further consultation opportunities for people to engage with that. As you'll be able to see with IFRS 15 and 16, we like to leave, with these major standards, leave a period of time for implementation by IFRS reporters before we then look at how we might implement that for UK GAAP, UK and Ireland GAAP reporters. And so IFRS 17, it will be some time, we expect, before we start to look at whether, and if so, how that might be incorporated into UK standards. So no changes at the moment. And another thing just to mention on that is that, of course, for FRS 102 and FRS 103, which has the current insurance requirements, these are all in the context of company law requirements, and there are some company law requirements relating to insurance, which will need to be taken into account in what, if anything, we do regarding insurance accounting. So nothing happening on that at present. And then the other thing, just to quickly mention, is that lease accounting in FRS 105 has not changed. So for 105, the big changes is revenue. Some of the other changes also apply, but leasing not changing there. And I will now hand over to Stephen to talk about some of that in a bit more detail.
Thanks very much, Jenny. Good morning, everybody. So over the next 15 minutes or so, I'm going to talk about the two headline amendments that Jenny's just told us about, and then say a little bit about some of those other incremental improvements and clarifications that Jenny and James have both flagged up already. So starting with revenue. And the headline on revenue is that we now have a single comprehensive 5-step model in both FRS 102 and FRS 105, because we've rewritten the relevant sections of those standards based on the model in IFRS 15. IFRS 15 has been effective since 2018, but of course you may not know anything about IFRS 15 if you're working in UK GAAP, so don't worry. Let's say a bit about how the new accounting there compares with the old accounting under FRS 102. And apologies because I'm going slightly off slides here, but bear with me. So under current FRS 102, we've got this sort of three-way distinction between the accounting for revenue from the sale of goods, from the rendering of services, and from construction contracts. And what it says is if you are getting revenue from selling goods, generally you're recognizing that at a point in time, and it's the point in time when a number of criteria are met, including when the risks and rewards of ownership of those goods have transferred to the buyer. If you are getting revenue from rendering services or from construction contracts, generally speaking, that is recognized over time based on the stage of completion of the transaction. But beyond that sort of basic distinction, current FRS 102 and 105 don't really give much information about how to apply the model to any given revenue contract and figure out how and when to recognize revenue. And there's quite a lot of reliance on an appendix that contains 27 examples of how the principles might apply in different situations. And so what we've done is rewritten, as I said, both 102 and 105's revenue sections based on the model in IFRS 15, and the model in IFRS 15 is referred to all over the place as a 5-step model. I will spare you for now going through the details of every one of those 5 steps, but effectively it means that the model can be applied to any contract with a customer. It doesn't matter whether it's for goods or services or whatever. You apply the model and you should get to a good answer. And the accounting follows the substance of what goods or services the entity has promised to provide to the customer, what we call performance obligations. And ultimately, at the end of that 5-step model, you end up recognizing revenue at an appropriate amount, either at a point in time or over a period of time, depending on how and when you transfer control of that good or service to the customer. Some of you will know the proposals that we published in 2022 in FRED 82. And so if you're familiar with FRED 82, you will notice when you look at the final amendments, there are some differences, and they reflect the feedback that we received to the FRED 82 proposals. For FRS 102, that really means that we've aligned more closely with IFRS 15 in some areas. And for FRS 105, we've made further simplifications compared with what we had consulted on. The key feedback for FRS 105 proposals really was some concern about whether microentities should be required to apply this model. We decided that we were really interested in having this consistency of the same fundamental model for 105, for 102, and indeed for IFRS. And I'll say a little bit more in a second about how we've tried to make that proportionate for microentities. So it's all well and good to understand what the new model is going to look like, but of course what a lot of people are interested in is how they're going to get there from here. And so it's really important to know about the transitional provisions, which are in section 1 of each standard. And for revenue, there are two options under FRS 102. You can either choose to transition on a fully retrospective basis or what we call a modified retrospective basis. And that's where you don't restate the comparatives, but you make a cumulative adjustment to opening equity. Under FRS 105, as part of making it simpler and more user-friendly, transition is prospective, so the new model is applied only going forward from the date of initial application. Briefly, for those of you who do know IFRS 15, you will find a number of areas of simplification in FRS 102 compared with IFRS 15. Some of those are called out on the right-hand side of the slide there. I'm not going to go into detail on those. Fundamentally, they are the same models and the outcomes should be the same in many cases. But when you get into the details, if you're really interested in those differences, you will find them. One of the key things to call out is that the new revenue section in FRS 102 and 105 is actually written around the 5 steps of the model. Because if you open IFRS 15, although we talk about the 5-step model, you won't actually find steps 1 to 5 as headings. You will in our standards, which hopefully makes them a bit easier to use. Finally, for FRS 105, as I said, we try to make it more user-friendly for microentities. So there are certain requirements that we think are less likely to be relevant to micros, which have been moved to the end of the section as additional guidance to make it a bit easier to read. There are some requirements where we thought they wouldn't be cost beneficial for micros, which are actually out compared with 102. And there's guidance, which actually is true of FRS 102 preparers as well. There's guidance towards the beginning that says if you've got quite simple transactions or you've got transactions that complete within one reporting period, it might actually be quite easy to apply the 5-step model to them. Sort of don't be too concerned about there being 5 steps if you've got those simpler transactions. We've tried to just make that clearer for microentities. So you may be wondering, and maybe I should have said this at the beginning, like what is the point of this? Why are we changing revenue accounting? Well, the FRC's overriding objective in setting accounting standards is all about users of financial information getting the right information, but it's also about doing that in a way that's proportionate for preparers. So we think as a result of these changes, it is going to be easier for entities to account for their revenue transactions correctly and consistently across all kinds of contracts and all sizes of entity. We heard quite a lot of feedback that the existing model doesn't really anticipate the sorts of contracts that entities are entering into nowadays and doesn't make it easy for them to arrive at consistent answers between different entities. So we think having a single comprehensive model will help, and that will help result in more reliable and useful information about revenue. A few practicalities before we move on from revenue. So the model applies to contracts with customers, as it says in the name, specifically those that satisfy step 1 of the 5-step model. This means that there is a first step that's worth taking of identifying which contracts are actually in scope of this. And the amount of effort involved in transitioning is probably going to be quite different for an entity that has one contract with the same terms for every sale to every customer versus an entity that might be agreeing bespoke contract terms for every separate contract, maybe with every separate customer. Because the accounting, again, as I've said, is driven by the substance of the contract and what's being promised to the customer. It's also important to know whether each thing you're promising to provide is as an agent or as a principal. One thing to bear in mind is we can't give a straightforward answer to whether revenue recognition will actually be different. Will you be recognizing any different numbers at any different times than what you currently are? It's not actually possible to answer that in general. And in a number of cases, you may find that you end up in the same place, but we still think there are benefits from the new model, and that also includes from enhanced disclosure requirements, both in the revenue section, but also actually some enhancements in section 8 around the accounting policy disclosures that are made. So do have a think about those disclosure requirements when you're planning for transition. More than enough time for now on revenue. The second of those headline changes is around leases. And again, the headline is that significant operating leases will come on balance sheet under FRS 102 because we've rewritten section 20 based on the model in IFRS 16. IFRS 16 has been effective since 2019, but again, don't worry if you don't know anything about it. Thinking again about the differences between the old and the new FRS 102. Under current FRS 102, as you probably know, each lease is classified as either a finance lease or an operating lease. And for the lessee, a finance lease is recognised on balance sheet, and an operating lease is off balance sheet, usually a straight line through P&L. Now, from the lessee's perspective, that distinction between finance and operating leases will be removed, and all significant operating leases will be recognised on balance sheet. What that means is the lessee will recognise a liability, which represents the obligation to make the lease payments, and will recognise an asset, which represents what they're getting in exchange for those payments, the right to use an underlying asset for a period of time. If you know FRED 82, again, you'll see some differences which reflect the feedback that we got in response to that consultation. So you'll find that the final section 20 is streamlined compared with what we had consulted on. There were a number of additional optional simplifications from IFRS 16 that we consulted on and decided not to finalise. And we hope you'll also find that it's proportionate for FRS 102 preparers, and I'll say a bit more about that in a second. Again, on the question of transition, how do we get there from here? Again, you'll find the answers in section 1, and this time there's only one approach to transition. It's the modified retrospective approach. So comparatives won't be restated. There'll be a cumulative adjustment to opening equity. But there are a number of choices to be made because there are a number of practical expedients available. And that includes, for entities that are reporting IFRS 16 numbers for group reporting purposes, there is an option to use those as the opening balances on the date of initial application at the start of applying the new FRS 102 model. As we mentioned a couple of times, there are no equivalent changes to FRS 105. So FRS 105 preparers will not be bringing operating leases on balance sheet. And accounting by lessors is largely unchanged. This is almost entirely about lessee accounting, although there are one or two things to look out for lessors, including around classification of subleases. Before I talk a bit about the areas in which we've simplified from IFRS 16 to FRS 102, there is one area in which we've actually added something, and that's around leases containing a non-exchange component. Now, you may know that FRS 102 contains a number of paragraphs for public benefit entities, and that includes how to account for incoming resources from non-exchange transactions, often donations. And it's possible for a lease to contain a non-exchange component. For example, if you have a corporate lessor who decides to rent out part of their office space to a charity at significantly below market rates as part of their charitable giving, there is a non-exchange component potentially to that lease, and there needs to be a way for the recipient, the lessee, to account for that. So we've included some paragraphs that hopefully will enable the appropriate accounting. On the right-hand side here, we've got some of the areas of simplification, if you do know IFRS 16, for what's simplified in coming to FRS 102. There are just two of these that I'd like to call out briefly. The first of them, second bullet point there, is about the borrowing rate. So both IFRS 16 and FRS 102 models require a discount rate because we've got to take that stream of future cash payments, the lease payments, and discount them to a present value to be able to recognise a liability. And both IFRS 16 and FRS 102 start off with using the implicit rate, the interest rate implicit in the lease in most cases, but in some cases there is a need to use a borrowing rate. And the borrowing rate reflects the idea that leasing an asset from a lessor is really economically comparable to borrowing from a lender in order to buy the asset that you need. And that's one of the reasons why you see a borrowing rate used as a discount rate. But the incremental borrowing rate that's required under IFRS 16 is something that we heard quite strongly from stakeholders was still quite difficult to determine. And so we've also allowed in FRS 102 an alternative to the IBR, which we call the obtainable borrowing rate, which is just simpler to determine and hopefully will result in no lessee being unable reasonably easily to determine the discount rate that it needs to do the accounting. Finally, and coming back to this point about proportionality, I've mentioned a couple of times that significant operating leases or most operating leases come on balance sheet. But there are recognition exemptions under both IFRS 16 and FRS 102, where certain leases do not have to be brought on balance sheet. One of those is for short-term leases, and the other one is for leases of low-value assets. In the basis for conclusions to IFRS 16, the IASB said that what it had in mind when it said low-value assets was something with a value of about $5,000 back when they were writing the standard. And in considering how to make this model proportionate for FRS 102 preparers, we thought that really there was some scope for us to allow a bit more leeway, to be a bit more permissive about where the line is drawn as to what is a low value asset. So from the FRC's perspective, we want to make sure that the most significant leases do come on balance sheet, but we've been able to allow a little bit more leeway in terms of lower value assets and being able to apply the recognition exemption to those. So what we've done in section 20 is given you a list of assets that we don't think are of low value. That's things like cars, ships, trains, aircraft, large pieces of equipment, and of course land and buildings. But below that, for things that are clearly of a lower value than the assets on that list, there is more opportunity to apply the recognition exemption and keep them off balance sheet. And the off balance sheet accounting then will look quite similar to current operating lease accounting. Again, what is the point of this? What are the benefits of having leases on balance sheet? I mentioned this economic comparability between a leveraged purchase and a lease. And really, it's hard to justify having operating leases off balance sheet given that similarity, and given, of course, that if you're borrowing to buy something, both the liability and the asset are going to be on balance sheet. So we think that this model will give improved financial information, greater transparency about the indebtedness of the business, more relevant information about its assets and liabilities. So some practicalities here. It's important, of course, to identify which contracts are in the scope of Section 20, because it's contracts that in substance contain a lease as defined. It's not necessarily the contracts that say lease at the top of the page, and it's not necessarily the case that contracts that don't say lease at the top of the page aren't leases as defined. So there's a bit of care needed to identify the contracts in question, and then of course to determine what the substantive terms are of those contracts, which will drive the accounting. I think most of those other practicalities I've already mentioned somewhere else, so I'm going to move swiftly on with an eye on the clock and talk a bit about those other incremental improvements and clarifications that James and Jenny have mentioned. So although the headline areas are around revenue and lease accounting, we've actually changed almost every section of FRS 102 in some way. And most of those are intended to provide some sort of incremental improvement or some sort of clarification. So not necessarily a change in the requirements, but making it easier to understand and apply. I've called out a subset of those on this slide, and I'll talk about a subset of that subset over the next couple of minutes. So James mentioned section 1A, small entities. And small entities in both the UK and Ireland are required by law to give sufficient disclosure in order to provide a true and fair view to users of their financial statements. But until now, we've only been able to offer a very short list of the minimum disclosures that are required as part of providing that true and fair view. What we've been able to do now for UK small entities is to lengthen that list and be a bit more prescriptive about which disclosures we think, when material, will be necessary to give a true and fair view. And we hope that that will reduce some of the judgment needed by those small entities in determining which disclosures they have to give. The situation for Irish small entities hasn't changed. Another one to mention on this slide is a small but significant new requirement in section 3 to disclose the fact that the going concern basis has been applied and to confirm that management has considered information about the future, which it's already required to do under paragraph 3.8. So this is just about putting in writing that confirmation in the disclosure. And in section 7, we've got new disclosure requirements about supplier finance arrangements. We think those are only going to be applicable to probably a small minority of preparers, but it's important to be aware of them, not least because they're effective a year earlier from the 1st of January 2025. There are a number of areas in which we've got additional guidance or clarification which is directly coming from stakeholder requests in our request for views phase that Jenny mentioned, where people said to us, hey, could we have a bit more on this or that subject, please? And there are some examples of where the answer was yes, you can. So in section 2, share-based payment, we've added more guidance to aid the application of the principles in certain situations. And in section 19, there's new guidance on accounting for uncertain tax positions, which is derived from IFRIC 23. Finally, I want to mention section 34, specialised activities, which is a very fascinating section covering lots of different areas, and some of you probably know it very well. We've made quite a few changes in section 34, including quite a bit of rewriting, but most of that is just about clarifying and making hopefully easier to apply things that are already required. That includes, in respect of incoming resources from non-exchange transactions, which I mentioned earlier, removing Appendix B to section 34 and building in what used to be an Appendix B into the main body of the section. And so we hope that that will make it easier for people to understand and to apply correctly. So thanks for coming with me on this whistle-stop tour of some of the key changes that we've introduced, and I will hand back to Jenny.
I'm not quite sure what's happened. I can't see the slides anymore. I don't know if we can put those back up, if it's just me. But I was going to talk about the fact that the effective date, which is 1st of January 2026, we already mentioned that earlier on, but as Stephen just mentioned, is an exception, particularly on the supplier finance disclosures, which are a year earlier. So there is a bit of time to prepare. Early application is, of course, permitted, which is usual, providing all the amendments are applied together. So you can't do revenue one year and do leases the next year, for example. It does all need to be done together. We will be publishing new editions of all the FRSs, which will reflect all the amendments, including others that have been issued previously since the last edition was published, and that hopefully will make it easier for people to access all the current requirements in one place, because we know it can be a bit tricky. Once there's been a few amendments, you've got quite a few documents to put together to create the current edition. So there will be new editions. That will be easy for people. We are also looking to update our staff fact sheets. Some of you may be familiar with the fact that we have a number of fact sheets out there, and they provide some limited guidance on key aspects of requirements. I think James mentioned earlier that if people have ideas for things that they might like to see in those fact sheets, please do mention them. Obviously, we can't promise that we will cover everything that people ask for, but we will certainly look at it. But those fact sheets, they are, as the name suggests, providing information on sort of highlighting requirements rather than giving a lot of interpretive guidance further to what's in the standard. And we've said their pipeline for future amendments. As I said at the beginning, the big comprehensive review takes place about every 5 years. So we won't be starting this process again for a little while. So in terms of significant changes, this should be, once you've done this, there should be a little stable platform. But what we can't rule out is other smaller changes. For example, we know that the Economic Crime and Corporate Transparency Act, when certain elements of that are commenced, we will need to make some amendments to the standard to reflect that change in the law. So there may be a few smaller things coming through that are reflecting changes in law or other requirements that are particularly relevant. And although we don't anticipate any at the moment, should there be any urgent issues, we would, of course, consider those on what we hope would be a timely basis rather than leaving them till the next 5-yearly review. In terms of what you should do now, if you're thinking, OK, what do I need to do to prepare my accounts? We did, when we issued the amendments in March, we had an implementation period of up to 21 months before the publication and the effective date. Obviously, some time has passed since then, with 15 months to go. So do start considering, if you haven't already, the impact of the amendments on your individual entities and plan for what you need to do to implement those. The impact will be different from entity to entity. There will be a need to look at contracts, as we've already talked about, and think about what that means for your own accounting. And the effect will vary a bit depending on the particular nature of the contracts that different companies have. Think about, as Stephen mentioned, the transitional provisions and any accounting policy choices, and work out which ones work best for you. And as we've said a few times, although leasing and revenue are sort of gathering all the headlines, there are other changes, and indeed some of those are intended to make applying the existing requirements easier. So do make sure that you review all the amendments to make sure you're complying with them, but also, it may well help with some things that perhaps have been tricky in the past. Think about engagement with users. Of course, as we know, the financial statements are there for the users, and if numbers are changing, you may need to think about how you engage with users about explaining those differences and what that means. And for those that are in sectors where there is a SORP, we are expecting all the SORPs to be updated to reflect the changes in FRS 102. So do look out for those amendments. SORP making bodies do need to go through a process of consultation where they're making significant changes to SORPs as well. So if that's something that affects you, do engage with that process as well and see how that affects your implementation. And of course, there may be other things that you need to do. It will vary from entity to entity, depending on circumstances. Thank you.
Thanks very much, Jenny and Stephen, for taking us through that. Really a lot to get through in such a short space of time, but thank you very much. Now, before we move on to the live Q&A section of this webinar, it would be great if you could leave us a rating for today's webinar. There will be a poll appearing on your screens now or in the chat box at the top of your screen. We really appreciate your feedback, so please take a few moments to respond. Okay, we will now move into the live Q&A. Please feel free to ask any questions, as I've already mentioned, using the Q&A box at the top of the screen. I'd like to firstly start with bringing IFRS 15 on the sort of revenue recognition side into FRS 102 and indeed to FRS 105. Jenny, Stephen, what do you think are the key practical steps entities should be taking to ensure that they are able to apply the 5-step model for accounting periods beginning on or after 1 January 2026?
I'm happy to start off there, James. For me, I think there are at least two, let's say two key things that I would start by thinking about. And the first of them is identifying, as I mentioned, how many contracts, how many types of contracts we have that need to be thought about under the 5-step model. Because if we've got a very straightforward contract that everybody signs the same contract, and that, at its extreme could be as simple as, we run a corner shop, people come in and they give us cash and they leave again. That's our contract, it's done, right? That's going to be quite straightforward. But if, of course, we've got hundreds of different types of contracts that are bespoke and they're 3 years long and there's lots of modifications to them and there's lots of different things we're promising, we've got a lot more to think about. So just starting with the scope, which contracts have we got that are affected by this? How difficult is it going to be to get into it? Would be my place to start. And the other place I would start, the other side of things would be I would start at the end as well and look at the disclosure requirements and think back, because the disclosure requirements are basically to provide more information to the user of the financial statements about your contracts, about your performance obligations. What are you promising to provide? So to be aware from the beginning of what the output in terms of what's in the financial statements needs to look like.
Thanks very much, Stephen. Jenny, anything you would like to add? Or?
No, I think that's a great place to start.
Thanks very much. If we go back to the leasing side of things, obviously bringing IFRS 16 into FRS 1.2, can you say a bit more about why no monetary threshold for low value leases has been included in FRS 102 or in the basis for conclusions?
I think we're setting standards that are aiming to be principles-based standards, and obviously that does mean that judgment will be required. And I think we didn't want to have that a sort of bright line for a cut-off point. And of course, as Stephen mentioned, such things, if it's a monetary amount, at the time you're thinking about it, of course, inflation can change that. So we would rather, with a principles-based approach and thinking about proportionality, we would rather set some set some parameters and allow entities to have some judgment, with, as we say, with the key point that really the significant items must be on balance sheet.
Thanks very much, Jenny. Has there been any discussions with HMRC in relation to the potential impact of these changes?
We do have contact with HMRC, and I think obviously, you know, tax matters are a matter for the government, but we do speak to HMRC from time to time, so they should be aware of these changes. Of course, IFRS 16 has already been implemented by IFRS reporters, and so the tax arrangements for that have already been in place for some time.
Thanks very much, Jenny. There is a perennial risk that accounting policies become boilerplate, especially if reporting entities follow policies generated by accounting software and don't review their policies each year to ensure that these are properly tailored. What improvements to accounting policies do you expect to see arise from the implementation of the periodic review amendments?
So I can take that one, James. I'm trying to find a thing on my other screen that will help me answer this. But one of the things I didn't mention in the other incremental improvements and clarifications is some amendments in section 8, which is about the requirements to disclose information about your accounting policies, material accounting policy information. And I wanted to particularly call out paragraph 8.5c, which says accounting policy information that focuses on how an entity has applied the requirements of this FRS to its own circumstances provides entity-specific information that is more useful to users than standardized information or information that only duplicates or summarizes the requirements of this FRS. So we're calling that out in section 8, that it is much more interesting, right, if your accounting policy information explains how you have applied these requirements for your material accounting policies. And adding on to that, particularly for section 23, it's also true of section 20 for leases. So 23 is revenue, 20 for leases. These requirements to provide users with a sufficient understanding of your significant revenue, of your significant lease arrangements.
I think if I could just add as well that, of course, entities will be going through a process of implementing these amendments. And I think sometimes, so they need to comply with those requirements as amended, but it's also an opportunity to stand back and look at what's been done in previous years and say, okay, can we improve that perhaps doesn't happen when the underlying policies haven't changed. So I think this, you know, taking the opportunity as well, not only to ensure compliance with the standards, but to think how can, we're going through more changes this year, how else can we improve this reporting?
Thanks very much to both of you. One of our attendees has a business which rents vans and short-term rentals around 30 to 90 days, which they extend as long as they need. Do these then need to be considered long-term operating leases and capitalised?
James, I really like this question and I didn't plant it. The answer, of course, is it depends. On the face of it, they look like short-term leases because the definition of a short-term lease is that at the commencement of the lease term is 12 months or less. However, there is a note of caution because the lease term also takes into account periods covered by an extension option if the lessee is reasonably certain to exercise that extension option. And so if, in the case of this business, they're renting these vans and the lease term is technically, say, 90 days, but they have every intention and the ability to extend it to, say, 3 years, and that's what they expect to do, then it might not be a short-term lease. So it's an example of where you need to understand what the standard is requiring and then think about how it applies to your situation. In other cases, of course, if you're just renting a van genuinely for 90 days and then giving it back, then yeah, looks definitely like a short-term lease.
So a great example there, Stephen, of exercising professional judgment based on the facts and circumstances, obviously taking account of, you know, what the standard says. But yeah, a very good question. Now, transitional arrangements have been designed to make it easier for entities to implement the new revenue accounting and lease accounting requirements. For example, in adopting the revenue accounting changes, entities can choose between full or modified retrospective application. However, with the range of options available, what practical tips would you give to accounts preparers in approaching first-time adoption of these two major changes?
One thing that I would say is there's a lot in here. Like, we've obviously tried to keep them proportionate. We've simplified in various ways from the international standards, but the sort of understanding that you're going to get from a short webinar like this one is necessarily going to be quite superficial. I would definitely advocate for spending a bit of time just sitting down with the new sections and reading them and understanding them. And of course, there'll be other guidance from other bodies, including ICAS, no doubt, that will help people to do that. Both the leasing and revenue requirements, as I've mentioned, really are about the substance of the entity's own transactions. And so it's important to understand the accounting model and to understand your own transactions and then multiply the two, basically.
Thanks very much, Stephen. We touched on the statements of recommended practice earlier, and obviously, these are important in a number of sectors, including charities. Is there anything further we can say in relation to these, and potentially, what advice would you look to give to entities who are relying on specialist SORPs in terms of applying these periodic review amendments?
I think there's a couple of things. So one would be do engage with the SORP making body's own process of consulting on whatever changes it is proposing to its SORP, and we would expect, I don't think we can give any timelines, but we would expect all the SORP making bodies to be consulting on some changes to their SORPs following such a range of changes to the standard. But the other thing is that, of course, a SORP is providing additional guidance on how to apply the requirements of the standard. It can't override the requirements of the standard. And so whilst it will provide very useful guidance on how to apply those requirements to the specific transactions or circumstances of that sector or type of entity, do start to engage already with the requirements of FRS 102 itself from the amendments, because those are the requirements that will be applied through the SORP. And so you don't need to wait until the SORP has been finalised to start thinking about what these changes mean for you. So do engage early, I would say.
Thanks very much, Jenny. Always great advice there. The more quickly we get onto these things, more time we will then to actually have to deal with them. Is there any insight on the expected cost of implementation? So was there a regulatory impact assessment, or is there any insight from the costs of implementing IFRS 15 and 16 that could potentially act as a rough guide to the changes we're now about to introduce into UK GAAP?
So we did do an impact assessment. That's part of the materials that we published. Of course, the impact on any individual entity will vary, and when we're making estimates of cost impacts, we're looking at a sort of average, and larger and smaller entities and entities with more or fewer transactions will be affected differently. So clearly there will be costs of implementation. In some cases, there may be some ongoing costs. In other cases, of course, we should remember that we do currently account for revenue and leasing transactions, just in a different way. So there may be changes going on to that, but we also, of course, consider the benefits. We've talked a number of times about the benefits of improved information for users, and we do consider that overall the benefits of improved information do outweigh the costs. And of course, there are other things that can have an impact too. For example, accountants are training on IFRS predominantly when they're doing their new training in the first instance, and sort of having consistent requirements across all entities brings some benefits rather than having separate requirements in FRS 102. So realigning, because of course FRS 102 started out consistent with IFRS on these topics. IFRS changed and we're now realigning, so that there are lots of benefits from these changes.
Thanks very much, Jenny. A great point there at the end. I mean, we very much appreciate our students are taught in IFRS, and the closer the UK standards are aligned, there's always a benefit in relation to the students going through their careers. In terms of revenue recognition, how will the new FRS 102 cover contingent discounts? And will the company size thresholds increase to cover impact from lease accounting on the balance sheet? Now, I know the latter one is for the Department of Business and Trade, but any thoughts there?
So the taking them in reverse order, yes, you're right. Obviously the company size thresholds are a matter for the government. You may remember that the previous government did propose earlier this year to increase the thresholds. It remains to be seen whether the new government will do anything similar. In terms of contingent discounts, I won't attempt to dive into all the details, but determining the transaction price is step 3 of the 5-step model. And so that includes things that deal with variable consideration. For example, do you actually know how much you're going to be paid for delivering the goods or services, or is there some uncertainty over it? And if there's uncertainty, how do you deal with that? And step 4 of the 5-step model involves basically dividing up the total amount that you're going to get paid between the different goods or services that you're going to provide. And that's one of the areas that can be quite complicated. Telecoms contracts often get mentioned in this case, right? When you get a handset, but you're paying less than it's really worth, and you're also paying for 3 years worth of network services, those kinds of things. How to allocate what is perhaps overall a discount versus the standalone selling price of the different things, how that gets allocated across the different components is in step 4. So I won't attempt to give a really superficial or quick answer, even if I could, to how to do that. But it is all in there, and I encourage people to familiarise themselves with it, and of course to raise questions with their advisors.
Thanks so much, Stephen. Someone is highlighting that their main concern for leases is the transitional arrangements and how to recognise the right of use asset correctly at the date of transition for existing contracts. They're asking, will there be any practical guidance on this published?
I also really like this question, so I'm basically not letting Jenny get a word in. She can answer the next 3. The transitional arrangements, firstly, the most important point, as I said, they're in section 1. Around about paragraph 151 is where you want to be looking for existing operating leases. The recognition of the right of use asset on the date of transition, we actually talk about the date of initial application, which is the beginning of the year in which you're applying it. So 1 Jan 26 if you're not early adopting. What you're basically doing is discounting the remaining lease payments at a borrowing rate at that date for each lease, and that gives you a liability. And then your right of use asset is determined based on the lease liability. I think there's also a mention, maybe in a different question, but there was a mention of having accrued or prepaid lease payments on balance sheet at the moment. Those are also going to go away as a result of the way the transitional arrangements, the transitional adjustments work, because of course the obligation that you have to pay for the leased asset is all built into your lease liability. So hopefully, firstly, I hope it is relatively clear in section 1, but also Jenny has mentioned the fact sheets and trying to make some of those things even more practical and easier to understand in some cases. We know transition is of interest, and we'll take a note of these particular requests and make sure that we can accommodate them as much as possible.
Thanks so much, Stephen. I think this will be the final question. For ongoing operating leases, what adjustment is required to opening equity? How are lease incentives dealt with that were given at the start of the lease? And currently there is lease accrual on the balance sheet relating to lease incentive. Client is looking to early adopt.
Effectively, see previous answer. And so lease incentives are another example of something that you might be carrying on the balance sheet as a separate, which way around is it? Liability? As a separate thing on the balance sheet, which, because of the mechanism of the new lease accounting, will end up bundled into the accounting. In general terms, for lease incentives under the new approach, if you have a cash incentive that is going to adjust against the value of your right of use asset when you first recognise it, and if you have a rent-free period, all that means, of course, is that your lease payments are smaller than they would otherwise have been, and therefore your lease liability is smaller, if memory serves. All of the answers should be in there, is what I'm saying.
Thanks very much, Stephen, and thanks very much, Jenny. Well, we're almost out of time. Jenny and Stephen, thank you once again for joining us today to discuss these important changes to FRS 102 and FRS 105. I'm sorry we didn't manage to get through all the questions submitted, but we will compile a Q&A document to address any outstanding key questions. We will upload this alongside the recording of this webinar on the ICAS events page after the in-person event on 18 September here at CA House in Edinburgh has taken place. And I hope to see some of you there in person. Please remember that you can keep up to date with all the latest professional news, including information, guides and resources on icas.com. Looking ahead, we have a range of webinars and events in the weeks ahead, which you might wish to sign up for. Online on the 24th of September, we have an employment status for tax purposes, policy and practice. Please join the ICAS Head of Tax, Justin Reconomy, for this insightful webinar, which will focus on employment status for tax purposes. This 1-hour session will offer a thorough update for the complexities surrounding employment status. On the 3rd of October, Scottish Charity Law Reform and Regulation, an update for finance professionals. This ICAS webinar will feature a panel of leading experts from Anderson Strathern and Oscar, who will provide an update on recent and ongoing changes to Scottish charity law and developments in charity regulation. On the 19th and 20th of November, we have the CA Summit. The CA Summit is back this year. Please join our award-winning virtual event to connect with the big ideas that are shaping the way you live and work. In person, on the 12th and 17th of September, we have Bank of England briefings, and we're also hosting 2 in-person events in Glasgow, 12th September and Inverness on the 17th of September, where Bank of England representatives will provide an off-the-record briefing on the economic outlook for businesses and households. On 18th September, we have, as I've mentioned, our in-person event, which will replicate what we have done today. But again, there might be further insights to be had. So I do look forward to seeing Jenny and Stephen in person in Edinburgh on that day. And then finally, on the afternoon of 8th October in London, we're holding our Shaping the Profession conference event, Beyond the Numbers. If you are curious about what tomorrow holds for the accountancy profession, then please join us to step into the future and delve into topics that go beyond the numbers at our upcoming conference. Links to sign up to all ICAS events are available at icas.com/events. It only leaves me to thank Jenny and Stephen once again for their excellent presentations, responses to the questions, and you, the audience, for joining the webinar today. I do hope that the webinar has been helpful to you. So thanks for joining us. Until the next time, goodbye.